is Medical Properties Trust, May 2022 stock valuation. What we're looking at right now is the balance sheet dated March 31, 2022. Just going to quickly go through what the financial statements look like, talk about some of the issues I've had. Then we'll go into potential for bankruptcy, and then we'll get into the actual stock valuation. So first off, first line, the real estate assets. It says land, buildings, improvements, intangible lease assets, and other. And some of the financial statements, they had these things broken out. And so I was able to really dial in, kind of what I needed to look at. Reason being is because intangible lease assets, I typically don't like to include in my valuations. And the reason being is because they're intangible, they're very subjective, and it's almost impossible to come up with an actual real number. So I usually take those out. Let me quickly show you what the notes look like. I spoke about this previously on another earnings call where I said you really have to kind of go into the notes sometimes, especially when you're doing a deep dive on these companies, to really figure out what's what. I think we talked about that with the off-balance sheet items concerning Entergy. So anyway, so I had to go into the notes to try to figure out what the intangible lease assets were. And so what you'll see here in this second paragraph, I'm trying to highlight it. I don't know if that's going to work. Where it says in 2021, the company acquired a total of $3.3 billion of land, building, and intangible lease assets. In making estimates of fair values for purposes of allocating purchase prices of acquired real estate to tangible and identified lease intangible assets, management utilizes information from a number of sources, including available real estate broker data, independent appraisers that may be obtained in connection with the acquisition of the respective property, internal data from previous acquisitions or developments, other market data, and significant assumptions such as capitalization rates and market rental rates. Okay, so what's really important to understand in this small paragraph here is that it says, and significant assumptions such as capitalization rates and market rental rates. Okay, so why does this matter? Because what they're saying is when they purchase a property, which that's what they do, that's their business, right? When they purchase the property, the way that they evaluate the value of their property is that they look at what is the potential amount of money that can be made because they own this property and they know they're going to rent it out. Okay, that is an assumption. Okay, who knows how long they're even calculating this stuff out? Or are they saying that, well, we know for sure we're going to be able to rent it out for 10 years, for 20 years, for 30 years? I mean, basically, the longer out you go, the more money you're talking about, so the more valuable that property is. And so that becomes really, really important, especially when you're talking about evaluating a company, looking at possible risk of default, because on the balance sheet, they're going to show, the building and intangible assets at this huge number here, okay, which is something like $14 billion, right? But in reality, a portion of this is actually intangible, meaning it's not real cash. And that value is made with a bunch of assumptions. They went through all of the things that they used to come up with that, but trust me, it's all assumptive. And the other thing to keep in mind is that when they report these findings, when they report these financial statements, they know that they're reporting them to investors. And so when you report your financial statement to an investor, you want the balance sheet to look good. So you're going to inflate the numbers. Everyone knows that. And that's the reason why when you do these default risk evaluations, you want to always make sure to discount those numbers. Now, like I said before, I was able to break out what some of these assets were and some of the other financial statements, but not others. So in order to have conformity and easy calculations, I included these assets in all of my statements. And that includes 2022, 2021, and 2020 and 2019, actually. So anyway, so that's that. The other thing that's important to note here is that land. I was really keen on breaking out land because land typically does not lose value, and so I didn't want to discount the value of the land. I wanted to keep that static, but again, I didn't have that option. So when I did my default risk, I just discounted everything, including the intangible lease assets. And because those intangible lease assets are in there, I actually discounted it a bit more than what I will have otherwise. All right, so all right, investment in financing leases. This is basically money paid in order to obtain a lease. Okay, and so these are going to be assets on the books. The reason being is because if they were to sell their business, they're going to also sell their book of business, meaning that they have these ongoing leases that are being paid out, and so those contracts, those leases themselves have value, and that's pretty easy to determine. Again, there is some risk in there because we're assuming that the hospitals and the operators are going to pay their rent and over the term of the lease. Okay, so I did discount that as well. So mortgage loans, I think that kind of goes without saying. These are loans made to these operators to basically purchase the real estate back from Medical Properties Trust. All right, cash and cash equivalents. I don't think I've talked about this before, but typically cash and cash equivalents, the reason why you see cash equivalents there is because stock is considered cash. So when you own stock, it is considered cash. And so while you would think that cash is just cash, right? It's really not. And so that number can really go up and down depending on exactly what's happening. And so we'll talk about that a little bit in the valuation. All right, interest and rent receivables sounds exactly what it is. These are rents or interest from loans that have not been paid yet but are due to Medical Properties Trust. And then straight line rent receivables is just the rent again that Medical Properties Trust is due. So they know they're going to get paid that, but we don't know when. Okay. All right. And then next thing is investments. Now these investments, I talked about this in the earnings call. Medical Properties Trust does do business with multiple companies, and the way they do that is that they will basically purchase a hospital, and then they will sell a portion of that hospital to another company, and they will create a partnership or a joint venture. All right, and so when they do that, they again create basically an asset on their balance sheet, stating what the value of their interest in the partnership is. Okay, and so that's what you see there, investments in consolidated and unconsolidated entities. All right, and then other loans and other assets. I did look this up. I'm trying to remember the other assets. Oh shoot, I don't remember. But anyway, other loans and assets are, what you think they are. I didn't need any. I didn't have any reason to take them out, so they're included as they are, and I did, of course, discount them as I did everything. All right, and so debt is pretty straightforward. These are loans and things that the company owes, whether it be a straight loan, whether it be a bond, what have you. Most of their loans and borrowings are over in Europe because of the lower interest rates. All right, and then accounts payable and accrued expenses. This is going to be, everything from salaries to what have you. Deferred revenue. Deferred revenue is basically money that they have not received, or I'm sorry, they have received, but they cannot they cannot put it on the books as received because of maybe some timing issue. Maybe this has to do with construction, because a lot of times what they'll do is they'll give a loan to a company to construct a building with the understanding that once it's constructed, Medical Properties Trust will then own that building. And so some of that deferred revenue can be that stuff. Okay, obligations to tenants and other lease liabilities. This is really interesting. Definitely want to monitor this number. This is, remember, Medical Properties Trust, they simply own the building. In most of their lease contracts, they don't take care of maintenance or repairs. That's completely up to the operator of the hospital to do. However, obviously, Medical Properties Trust does have some sort of liabilities to these tenants. And so that's what we see there with obligations to tenants and other lease liabilities. What some of that stuff is, I don't know, honestly, but obviously it is money that is owed to the tenants. And so that goes back to what I mentioned in the earnings call summary, where Medical Properties Trust is purchasing this real estate, this hospital, from the original owners. But on top of that, they're also doing all of these side deals, right? That is putting more cash in the hospital operator's pocket or in the previous owner's pocket. And the purpose of that is that Medical Properties Trust is going to gain some benefit outside of not just rent, but maybe forming some relationship to then profit from some other property, right? Or future properties or what have you. The problem with that is it becomes really hard once you break all this stuff out to really understand, okay, how much are they really profiting from these deals if you have all these other things on top of the cash that they paid, right? So anyway, so that's that. Let's see, what else? Payables due to Medical Properties Trust. This one, I didn't look at either. I just took it as it is. These are going to be items that are due to themselves, basically. Medical Properties Trust, like many companies, is made up of a lot of different entities. And so these entities, they borrow money back and forth. They transfer back and forth, just like many of us do. We have multiple accounts and we transfer from savings to checkings. And so anyway, there is a liability due to the company themselves. All right. The other thing is the shares. Okay, so what you see here is general partner shares and then limited partner shares. Typically, the general partner shares are going to be what's considered preferred shares. Okay, I don't think I've ever talked about that on this channel, but preferred shares are simply stock shares that get paid out before anyone else gets paid out. And so most people are allowed to purchase preferred shares. You do have to spend, quite a bit of money to get them. I think the minimum purchase price is maybe something like $10,000 or $100,000, something like that. But when you purchase these preferred shares, instead of making money on the stock price going up and down, a preferred share gets a guaranteed payment every quarter, every month, or every year. Okay, and so when you purchase a preferred share, maybe you're purchasing a preferred share at 8% interest or 5% interest or whatever, and so you're guaranteed that payment every quarter or every month or whatever. And then when you sell your preferred share, you basically sell it for the exact amount that you purchased it for. It is highly unlikely that your preferred share is going to be worth more when you sell it than when you purchased it, but it does happen. All right. So anyway, on the financial statements, the preferred shares and the common stock is broken out typically. For Medical Properties Trust, they are a partnership, okay? They are a REIT. And so that's the reason why you see general partner versus limited partner here, other than preferred share and common shares. One thing also to note, and I talked about this in the earnings call summary, is that Medical Properties Trust does issue shares, meaning that they do sell stock in order to get cash to do these deals, to buy these properties. And so we will see that the number of shares will increase over time. All right, so let's quickly take a look at the default risk. And so what you have here is the 2022 numbers. All right, so we have cash, receivables, investments, other assets, property, and then this is total assets. Maybe I need to blow that up or something. That's total assets, and then we have total liabilities here. All right, and then this is our net. Actually, I'm just gonna that red. I think that's good. All right. So first things first, we see that the company does in fact own more than what they owe. So that's really good. One thing that I wanted to do here is see exactly at what percentage rate, just for fun. Let's see. Oh, wait. Wrong button. All right, there we go. All right, so 42%. So that's really good. What that means is that they own almost 50% more than what they owe. And so that is a very stable, a financially stable company. It's good to see. The other thing that I want to take a look at was the percentage of cash that was able to cover the dividend payment. Okay, so remember, this is a REIT, this is a partnership, and so all of the profit gets paid out in the form of distributions or dividends to the partners, to the shareholders. Okay, and so we want to know whether or not they have the cash on hand to take care of those dividend payments. And so even if we look at the conservative and the moderate scenarios here, they still have roughly 30% of the cash necessary to pay the dividend. Now, of course, they are also going to be making cash from their profits to pay the dividend, but 30% cash is not great, but it's not horrible either. Of course, we're not looking at this relative to any other companies, so there's not a lot to say there other than the fact that, 70% of the dividend payment has to come from profit. Other than that, conservatively, again, this is discounting a lot of the property. As you can see here, I discounted the property about 50%. Okay, so what that means is if this company were to go out of business and they had to sell all their properties, we're going to assume that they're going to sell their properties for half of what they're actually worth right now today. That includes all the intangibles and so forth. If that happens, then in fact the company is bankrupt. Okay, moderately, however, discounting roughly, I want to say, roughly 70% of the property, and I think I did like 80% of everything else. 85% of everything else. They're still flush. They still own more than they owe. So in the very worst case scenario, yes, in fact, this company is insolvent, but moderately, they're okay. And so I think we can be happy with that. They're not in any danger of default. All right, so let's take a look at the valuation. All right, so first things first, the cash is an interesting story. The CEO, CFO said that they have about $1 to $3 billion. Okay, currently, right now, their March 2022 balance sheet says that they have about $2.5 billion. I got to make sure I do the math here. So no. I'm sorry. If I put 3 zeros behind that, that's 250 million. 250 million is what they have in cash. But they say that they have up to $1 to $3 billion. I have to assume that a lot of that is coming from loans. Okay, because they said that they're not going to issue any stock to do any deals. So what we're looking at is from 2019 through 2021, the cash has come down every single year. And so I expect that to continue. I'm sure that the cash position has come down because the company is always making these acquisitions and buying more hospitals and more properties. They just finished purchasing the properties in Finland. I don't know if the March 2022 balance sheet reflects that new cash position, but again, just based on historical numbers, we have to assume that the cash is going to be a lot less at the end of 2022 than where it is now. All right, so receivables have consistently gone up. That's not a great thing necessarily. It can mean, however, that the company is growing. And so because the company is growing, they always have more rent coming in, but that can also mean that they're having a harder time getting paid, because a receivable means that you're owed the money, but they haven't paid it yet. And so it's possible that that's what that can mean. So again, currently the receivables are sitting at 72, and so we assume that they're going to increase just like they did the last 3 years, and so that gets us to this 106 number. All right, investments. The investments are coming from the joint ventures and the partnerships, and we know that they are definitely looking to do more of those. We see that has increased almost 100%. Between 20 and 2021, only 20% between 19 and 2020. Just to talk a little bit about how I came up with the numbers, I decided to go with just an average. So if we look at the average increase between 2019 and 2021, that puts us at a little less than 50%, okay? Somewhere around there, maybe even 60%. No, yeah, less than 50%. So anyway, so, does it, it increased 100% last year. Does it go up 50% this year, 2022? I don't know, but it is possible. Maybe we can play around with that number. I think there's definitely some potential for change there. All right, so the other assets. These other assets have kind of fluctuated quite a bit, up 32% and then down 64%. So again, just looking at an average, we expect that number to decline, and it's really close to what it is now, 49 versus 59. In order for this number to really come down means that they would have to basically get rid of some of their securities, because that's what these other assets basically are securities and investments in the stock market and things like that. I can see that happening, especially with where the market is now. I mean, if they exit some positions, I wouldn't be mad about that. All right, property. Property, again, they've consistently done acquisitions. We expect that to continue, even though the CEO said that he's not going to do any big acquisitions. Again, this number may or may not include Finland. So again, just looking at an average, it's going to increase about 20%, 25% from where it is now. And so that gives us a growing asset balance sheet. And so that's really good. You like to see that in a company. The balance sheet grew 17%, 20% over the last 3 years, and so we think that's going to continue. All right, so looking now at the lease obligations. Okay, so again, these are monies that are owed to tenants, whether that be some sort of agreement for maintenance, whether that be some agreement for just some cash that they're having to pay to the operators for the benefit of owning their building or purchasing their building. We see the number has consistently increased over the last 3 years. When something happens 3 times, we call that consistency. So we can be confident in that continuing. Does it mean it will continue? Not necessarily, but there's a good chance that it will. It increased 34% and then 9%. So I just did an average of that to get us that 20 number. Deferred revenue, we talked a little bit about that. That's kind of been all over the place. For this one, I actually did a standard deviation on this. And so what I then have to do is decide whether or not this standard deviation is going plus or minus. The problem is if I go minus, then deferred revenue is a benefit, which I seriously doubt that happens. And so I'm going to assume that that number increases. And so that takes us from currently 18 all the way to 44. The problem with that is it's never been 44. So I don't know what to do with this one. We know, just going back historically, that they've always had some deferred revenue. And so I think it's not a bad idea to just assume that that number is going to remain the same because we just don't have good data to give us any sort of real prediction. And I think even if I did an average, that average is going to have us, plus what, 50% of where we are now, which is still going to be damn near 40. So it has been close to that before. Can it get back there? Yeah, but I'm not sure what takes it there. So again, something that we can kind of play around with. Debt has consistently increased over the last 3 years. We expect that to continue, especially being that they're not going to be selling any shares at the moment. And so I did an average there as well to come up with roughly, looks like 25%. All right. Liabilities have consistently increased over the last 3 years. And I'm really curious to see if they've increased more. Yeah, see, so 25 there, 21 there, and then increased 27 there, 17 there. So liabilities are increasing faster than assets. That's not a great thing at all. But at the same time, when you talk about the life cycle of a business, you talk about the life cycle of finances. As the company grows, as they get older, they're going to take on more liabilities and more debt. That's just kind of the way it works. The important thing is that on net, the balance sheet is growing. So every year the company is getting bigger, they're getting stronger, consistently growing, right? So we expect that to continue. It'll be, again, in playing around with some of these numbers, I forget now which one I'm looking at. The investment, if we brought that down some, that's going to definitely decrease the value. And then the deferred revenue, that can increase, and then that's going to also decrease book value. Currently, let's see what it's at. I'm curious here. So increase 34% is what I have right now. It's very possible that it will increase, but not increase 34%. So let's do this. First thing first, let's bring down this investment. It's a good chance that they will do another joint venture, but maybe not that big of a jump. So let's just bring this down to 400. Yeah, small increase. It's at 300 now, so we're saying 400. Other assets we'll leave there. Properties, I think we're good there. That's an average. And then the deferred revenue is what I really want to take a look at. So let's increase this to, let's go up to 40. All right. And so now we have a declining balance sheet. I don't expect that to happen. So let's come back here and let's keep the deferred revenue stable. And that still gives us a declining balance sheet. There's just nothing else I can imagine playing with here. Let's go back and let's go to 500, maybe. I mean, that's hard for me to say because it was 112 here, 244 there, and it's currently at 300. So at 500, will definitely be an increase. Yeah, this is a hard one. I honestly, I'm not sure what to do with this. Let me make sure my numbers are right. I think, yeah, I think the problem is I have this number wrong. This is not 500. This is 5,000. So let's do 4,000. There we go. All right. So 4,000 gives us, again, a declining balance sheet. Wow. So, yeah, I mean, it almost appears as if the balance sheet either has declined or they have to do some sort of joint venture deal. They got to come up with something. And again, consistency is where it's at. And if they're going to consistently grow this balance sheet, which they have done, let me make sure I got this right. 1, 2, 3, 4, 5, 6, 7 numbers. So 4, 1, 2, 3, 4, 5, 6. Yeah, I mean, if they're going to continue to grow their balance sheet, they're going to have to either do another joint venture and get more money in from their investments, or they're going to have to reduce, and I mean really reduce, their liabilities, which I don't see happening because they've grown their liabilities consistently for the last 3 years. So yeah, I mean, especially if they're saying they're not going to do any big deals, they're going to do smaller deals. I have to imagine that some of those smaller deals are going to include more joint ventures. At this point, I just have to assume that's what's going to happen to continue to grow the balance sheet. And need to actually do this number again. 1 second. So I think I said 34%, but that's not correct. It's actually a lot less. I used the wrong number. There we go. So yeah, so grow the balance sheet, 9%, almost 10%. That sounds about right. But in order to get there, like I said, they're going to definitely have to do some more investments to get this number up from 3 to 5. All right, so let's take a look now. Again, they said they're not going to issue shares, but we're talking about the end of 2022. Once the stock price gets back to where the CEO likes it, then they will potentially issue more shares. And so I'll just assume that they're going to grow those shares on average. And so you see that they've grown them, 4%, 9%. So currently the shares are at 592. We're expecting the shares to grow to 633. And so that gives us a current share price of $16.62. Currently, the share price is $18.10. And so that gives us a price to book of 1.09. That is really low just on its face, okay? And what that means is that the stock price is literally worth what the company's balance sheet is, right? So if you take into account everything that the company owns and everything that they owe, and then divide that by the number of shares, then basically the stock price is exactly that. Okay, for the most part, you can imagine that that 0.09 are some of those intangibles, maybe. Okay, um, so 92% of the stock price is made up of the balance sheet. All right, now looking historically at this, okay, looking historically at this, we know that over the last 3 years, the price to book has been between roughly 161, or really just let's just say 1.5, right? And it got all the way down to 0.82 back in 2020. I imagine that had a lot to do with the COVID low, okay? Because what I did was I went through and I took the lowest price for the year, and I went through and took the highest price for the year, okay? So at the very lowest, the stock price got down to $12.35, which meant that the stock price was actually lower than the balance sheet. Anytime you see a price to book of less than one, that means that either someone knows something that everyone else doesn't know, or that stock price is really cheap and you're buying it at a really great price. And so 0.82 is when the stock price was down to $12.35. And we all know that the COVID low went V-shaped recovery when we came out of COVID, and the stock price jumped up to $24, and that gave us a price to book of 161. So historically, I'm going to say over the last 3 years, okay, we're not going back any further than that, the price to book hovers at around 1.5 and 1. Okay, because that 0.82 in 2020 is just craziness. Currently, we're at 1.09, meaning that we are at definitely the bottom of the range. We can expect that the price to book is going to get back to roughly that 1.4, 1.5 number. So again, we're looking for the price to continue to move. Same thing goes, the percentage of the stock price having to do with the balance sheet, 92%. That says a lot. That means that this stock really does move based on the balance sheet for the most part. So it's important to look at that. So 69%, 84%, 62, 122, 68, and 95. And so again, 92 puts us at the bottom of the range going back to 2019. And so we expect this number to decline, meaning that more of the stock price is going to be made up of hopefulness and optimism, right? Right now, almost 100% of the share price is made up of the balance sheet, meaning that people are not willing to pay more than what they can see on paper, meaning that there is not a lot of hope for the future. So that gives us a stock price of anywhere from $16.57 to $25. Now, the thing is, and this bothers me, is a lot of this stuff has to do with timing, right? The stock price, I don't think made it to $25 in 2022, but I know it got close. I had this queued up earlier. I closed it out, but let's take a look at it. Looks like the stock market is up almost 2% so far this morning. Uh-oh. Whenever that happens, I just know it wasn't my fault. But it had to be, right? All right, so what we're doing is we're looking at 2022, and we're looking at the high. So looking at the highest this stock price has been in the year 2022. And so we see 1997, 20, 71, 21, 69, 22, 23, 24. See that? And so this becomes a problem because it's very possible that for the year of 2022, this stock has already touched its high and will not return. It's very possible. And so we have to go back to, the real estate sector itself and ask the simple question, does the real estate sector see any sort of comeback? And we know that it hasn't performed well. And the question is, does it perform better? What are some of the things that can create that environment to allow the real estate sector to perform better? The only thing that I can think of is that somehow we become unafraid of recession as a possibility. It's the only way. It's the only way. We become unafraid of recession as a possibility. We become unafraid, or I guess maybe we get used to inflation. Inflation no longer is an issue. Outside of that, I don't know what helps. Now, medical properties trust, as I mentioned before, when interest rates rise, they do tend to make more money because it's written into their contracts that rents go up as rates go up, but it also means that their borrowing costs go up as well. So how that's going to play out in the market and what people are going to think about that is what matters, right? Because as rates increase, investors are going to say, oh, well, that's great for medical properties trust. Or they're going to say, oh, that's horrible for medical properties trust. So I've talked about in earnings calls before with these guys. They do definitely have some variable loans, which are, something that will hurt the company for sure as rates rise. So at this point, I have to assume that based on current market data, let's call it data, based on current market data, medical properties trust has already touched its high for the year, which was that $24 and change. I don't think it'll get back to that 25. Matter of fact, I think it's very possible that we see it get down to the 1657, because that 1657 is actually an average. It's an average of the, I want to make sure I get this right, is an average of the lowest it has been over the last 3 years. Okay, so it takes into account 2019, 2020, and 2021. And on average, where the stock price currently is, it can get down to 1657. We're currently at 18. And that 18 is only because the stock price has had a nice little jump over the last couple of days. It was actually down to about 17 before. So getting back to 1657 is definitely possible, especially as more news comes out, as things continue to happen. We have a long rest of the year to go. All right, taking a look now, this is part of the default risk. This is how much cash is available to cover the dividend. Currently, the number stands, and this is based on prediction. Okay, this is based on prediction. Number stands at 21%, which is the lowest it has ever been, and so that is an issue. Okay, that is an issue, not a default risk issue, just an issue because the company, if they think the dividend is getting too expensive, can choose to cancel the dividend or reduce the dividend. Medical Properties Trust has done a really good job at increasing the dividend every year. And so we expect that to continue. But again, if they think that it's going to be a problem, they can cancel it, they can reduce it. All right. The other thing important to mention, we talked about this in the earnings call, the CEO, the chairman of the board, owns a lot of stock, and so that dividend is his money. That's how he gets paid. And so the chances of the CEO and chairman of the board reducing the dividend is highly unlikely, but it is possible. The other thing to think about when looking at such a small number relative to what it has been historically is that maybe the cash on hand is going to actually increase, or maybe it's going to remain the same. So currently, like I said, they're sitting at 2.5 million, or I think that's, yeah, sorry, 250 million, quarter billion. And so we're assuming that because of historical averages decreasing that cash balance, that the cash balance is going to come down. Maybe it doesn't. Maybe it stays the same. Maybe it somehow increases. I don't know how that happens, but that is a possibility, because that, again, that 0.21 is a very small number relative to the rest of the years here. All right, profit and dividend. So again, remember, the company does make profit. They are profitable, and so because they are a REIT, because they are a partnership, the profit that the company makes goes to the shareholders. All right, the shareholders is going to get their money, and therefore the profit I shouldn't say more than covers. The profit covers the dividend. Okay, it covers it, one time. All right. In the past, however, it has covered, 1.5 times, 122, but it's always been about one time, really. And that's typical. I don't think that's an issue there. So it's not like they can't pay the dividend, but if there becomes conversations concerning credit, right? If there becomes conversations concerning, taking on more debt, then their cash position will come into question. Matter of fact, in the financial statements that I went through, the CEO talked about a lot of their loan contracts specify that they can't issue certain number of shares of stock. They can't do this, they can't do that. Banks are very specific about what companies can and cannot do when they're borrowing money from the bank. And that's the reason why a lot of these financial statements and stuff like that have to be filed and have to be on time, because the bank requires it. Okay. When you see the cash dividend ratio that low, you have to imagine that at some point someone's going to say, hey, you guys need more cash, or you guys have to figure out something, because we don't like your cash position at the moment, right? So maybe that means selling some properties. Maybe that means, again, doing some more joint ventures or something like that to get that cash position up. But either way, something's going to have to happen, because that's a historically low number, and really, really scary when you get down to 0.2. I mean, how far is 0.2 from 0.05? You know what I mean? So anyway, enough of that, but something to be concerned about for sure. All right, looking at the profit loss statement. Revenue has consistently increased over the last 3 years, so we expect that to continue. Cost of goods sold has always been about 98%, so that means that our revenue and the gross margin has always been about 98%. So that means that our revenue prediction and our cost of goods prediction is probably correct. It may be off by 1%, maybe, but that means that we're good there. All right, payroll. This is just, payroll, paying your employees. That number has consistently increased. We expect that to remain the same. I predicted this number just based on a simple average over the last 3 years. All right, sales. Now, sales is interesting because this is literally selling properties. Okay, now, back in 2020, we see that they took a loss on sales. That doesn't typically happen. Typically, they make a nice profit on selling those hospitals that they purchased years ago after renting them out. And so currently their sales are sitting at 451. We expect a modest increase to 480. This was done based on standard deviation, just looking at the numbers from the last 3 years. It was 41 in 2019, negative, and then 52, and currently sitting at 451, which is, a crazy number. But, what can you do, right? So does that number double this year? I doubt it. So we have a modest increase. Yeah, I don't, maybe we can play around with that number, but it's already historically high. I can't imagine it going much more than that. All right, taxes. Again, taxes have really been just all over the place. They actually had a tax refund in 2019, but 31, then 73, currently sitting at 11. But again, we have, the rest of the year to go. So I'm sure that we're going to see an increase in the tax liability from here. I think 4950 is really kind of in the mid range of what it has been over the last 3 years. Without going back another 3, 4, 5 years, I don't know how common tax refunds are for this company. So I'm comfortable with keeping the tax at where it is. Maybe that's something we can play around with, but I don't think it'll change much. All right, so other expenses. Now this one is interesting because this is all about their stock and their securities that they own. We know that the market is taking a dive, and so while that number has kind of been all over the place last 3 years, I expect it to actually get worse. And so currently it's sitting at negative 1,000, and so I have that going all the way to a negative 15,000. Will it get down that low? I don't know, hard to say, but it has been somewhere near there in the past. In 2020, it was negative 34. Remember, 2020 was the COVID drop. That was the COVID low. And so roughly half of that for 2022, I don't think is a crazy number, especially, again, because it's been negative every single year. Okay. All right. Investments. This is going to be income. Let me make sure I got that right. 32. Yeah, income. So again, this is money that these joint ventures are paying to Medical Properties Trust. As you can see, they have increased that number consistently over the last 3 years. We expect that to continue. Currently, it's sitting at 73. We have it jumping to 97. So again, more joint ventures are going to have to be done to get that number there. And this was done just on a simple average. Okay. So again, we have to expect that more joint ventures are going to be done. Maybe we have some outsized joint ventures that's really going to move the needle. I don't know, but we're predicting that they're going to do some more joint ventures. All right, so distribution. These are monies that are being paid out to other entities. Like I said, Medical Properties Trust has a lot of entities, and so there's a lot of inside dealing and things like that between these companies, and so they do have that liability on the books, right? But they also have an expense too. So when cash is paid out from their liability, it gets booked here into the distributions, is what I'm calling it. And so we expect that number to definitely decrease. So as you can see, it hasn't really been all over the place. I mean, you're talking about 17. Yeah, it's a 50% drop, but 17 is really not far from 800. It's still kind of in that $1,000 range, and then it increased slightly from 20 to 21. Currently, it's at 266. I have to imagine those distributions are going to continue, and I don't believe they're going to get any lower. So I'm comfortable with that 700. Maybe that's a number that we can play around with. Interest, definitely expect that to increase. It has consistently increased over the last 3 years, and I actually expect it to increase more in 2022. And so I'm comfortable with actually adding something to that. But let's take a look at our net profit. And even though they have consistently increased their net profit, I have them actually losing money in 2022. And I really think that is indicative of the stock market having a drop, as seen here in the other category. Now, in 2020, even with that large drop, they were still able to post a gain in profit year over year. And it appears that the additional money, even though they lost 34,000, it looks like the additional money, and they lost money on sales too, right? They were able to increase revenue, so they must have purchased a property. The interest expense went up, of course. The distribution came down, but not enough to offset 35,000. But the revenue definitely improved quite a bit. Let's see what the assets did. So property only went up about 25%. Receivables went up 40, almost 50%. So I think that's what's happening here. Is I think that the receivables, which is that rent that is due to them upon completion of the contract. So once they purchase that property and they sign that customer to that new lease, that lease contract itself is revenue, right? And before the revenue is actually paid, it's called a receivable. And so, again, when you have that new property or you have some new contract, you have receivables going up. Maybe that's how they did it. Again, the only way I see them growing the bottom line, growing their profit, is they're going to have to increase their investment by quite a bit. So increase 27% and then 40%. Let's see what I have it at now. So I have it increasing 33%. So that's a decent number. Maybe they do an outsized deal. And so instead of 33%, maybe they increase it, 50, 60%. That's possible. Definitely possible. Revenue, I have that. Well, no. Don't want to touch that because we know that that's correct because our gross margin is still 98%. And the cost of goods sold, I'm showing it as a decrease. But I'm also showing revenue as a decrease. So that's a problem. So let's figure out how to fix that. 553. Yeah. So that's a problem. currently, so over the last three, so in 2019, revenue was 850. Okay. In 2020, revenue was 1.2. 2021, revenue 1.5. Currently, revenue is only 400, which is half of what it was in 2019. So the revenue is going to be way more than 500, way more. So let's do this. Instead of doing an average, let's do standard deviation, because we have to use some statistical math to predict this thing. So see what we come up with here. So C25 plus. Oh, wow. So there's something weird going on here. So even using a standard deviation, the revenue is still way down. But I at least now have a growing net profit. And so this is really interesting. I didn't notice this when I was going through this. The other thing is I'm going to have to consistently increase this number too. So what I'm going to do is I'm going to put this number at, I'm just going to say 98%, and just make sure. Oh, wait a minute. No. There we go. Okay. So that would be like a almost 50% increase, which is not unheard of. But the revenue is still a lot less. So the only way that revenue can drop like that is if they either hospitals stop paying, or they sell a lot of hospitals. And if they sell a lot of hospitals, then we expect not only sales to increase by quite a bit, but we also expect cash to increase as well. Now, we know that the sales are already historically high. So for revenue to drop is expected, right? But then we expect cash to rise. And so I wonder if there is some timing issue where it just so happens that let's make sure we're looking at the right numbers, because, maybe I made a mistake. So this is cash from 2022. And yeah, I know I have cash at 248846. This is really interesting. Yeah, I mean, we have a real problem here. The numbers aren't making sense all of a sudden. For revenue to drop by half, there's a lot of sales going on, but then that means that cash has to increase. There's just no way it doesn't. So either we're going to have to drastically increase revenue, or we have to drastically increase revenue, or we have to drastically increase cash. It's one or the other. The cool part about this is that if we leave revenue alone and we drastically increase cash, we know that the stock price moves more with the balance sheet than it does the profit loss statement. this is a hard one. So let's do this. The question is why? Why is revenue so low? And you know what I want to do in this situation is I want to go back and look at the other quarters. I'm not going to do that right now, but man, I really want to go back and look at the other quarters because I have a feeling that what's happening here. See this 409,800 currently. Okay, this is March 2022, and then if you look at last year, March of 2021, revenue was only 362. And so what that means is that between March of 2021 and December 2021, the company pulled in something like what? Like that's a crazy number. 1.2 billion in revenue. It's almost as if all their money comes from the end of the year. And so if we know that, and I think this is a mathematical way of doing this. Let's look at the difference between where we are right now in 2022 versus 2021. Let's do that. So see 409, 800 and 362, 765, 362, 765, 362, 362, 765. Okay. So let's do this. Because currently, right now, as we are, so as of March 2022, we have made 13% more revenue than what we made last year at the same time. So we can say that that number will remain the same. And so we'll simply take last year's numbers and multiply it times the change. And so that gives us revenue of 1.7. And so that's a 13% increase, which is lower than what it's ever been because we're looking at 46 and then 23. And so if we get a 13% increase, that actually that would be historically low. So if we do that and cost of goods remains the same, so 35 roughly versus 39 still keeps us at that 98% gross. That gives us a huge jump in net profit, which I'm not excited about because I just don't know if that happens. Yeah, it's 100% increase. There's no way. There's no way that happens. And see, it's 21. So we're gonna have to make this almost twice. We want to offset that even a little bit. Sales, yeah. Maybe they sell some properties at a loss, and so this number comes down. Taxes are decent. The losses on the market, again, I think we can increase the losses there. But even if we double that, even if we double it, it still gets us at almost 100% net profit from year to year, which I can't see that happening. There's just no way. Yeah, so I mean, this is really difficult. I mean, again, something has to happen. Um, I am okay though with keeping the revenue where it is. I'm okay with that. Um, but we have to do something to reduce this net profit. There's just no way it it stays there. So let's increase the interest, because we know for sure we can expect to have an outsized interest expense for 2022 just because rates are increasing, right? Um, Taxes can definitely increase because we have such a large sale, right? So let's kick the taxes way up. Investments, I'm okay with those. Staying there. And that's actually a decrease, which we can't have that. So, and I think this goes back to the revenue as well. Oh my goodness. So then what we'll have to do is the same thing I did with the revenue, actually, which is looking at D instead of C. So it gives us investment income of 37, which is a small increase from, well, not a small increase, but a decent increase from last year. Okay. Um, let's do the same thing with payroll. These sales are good. Taxes, yep, increase. Okay, we have a loss on investments. You have an increase in investments. You have an increase in distribution. Well, yeah, a decrease in distributions, um, which we can increase that. We want to bring this down further. Interest, we have, but I would, well, actually a decrease. So let's switch that one up. Let's go there. So we have an increase in interest, which is about average. And so that still gives us roughly a 50% increase in net profit. Make sure. Yeah, 50%, which is historically high. Can that happen? It can, but I'm more comfortable with it being at that average of roughly 30%. So that means that we have to increase or decrease something. And so what I'm going to do is I'm going to increase the distribution. really, honestly, not sure where that increase will come from. Maybe there's something that happens within the joint venture or something that requires some sort of distribution. It's possible. Payroll's increasing. Sales, small increase. Taxes increasing, but not a lot. But again, it's kind of been all over the place, so I think I'm okay there. Again, stock market lost 21 last year. Let's go ahead and increase that based on last year's numbers. That puts us above the COVID low, which I don't know about that one. But who knows, right? So we still have investment increasing because, again, I'm sure we're going to do some joint ventures or something there. Interest, decent increase, at least 20%. And it still gives us a net profit, I think, in the 50% range. At this point, I think I just have to leave this number here. And I've definitely ran into issues before, but this one is a little different for sure, because while it's very possible the net profit can increase 50%, it's hard for me to see it getting there. And the last thing I want to do is look at a real valuation based on numbers that don't make a lot of sense. I don't know what else to do though, other than maybe bring down the investment income. But again, it doesn't make a lot of sense if we know we're going to do these joint ventures. Revenue increasing 13%. Yeah, I mean, I think that's conservative. We can increase payroll, but it's already increased by, maybe 10%, 15%. Taxes, yeah. Losing more money in the stock market, more than what they lost during the COVID low? I doubt it, right? Investment, distribution's going up. Interest is going up. I mean, do we just increase interest by lots? I can't imagine. Let's see what happens though. I think I can do it here. Let's see. Yeah, let's just increase interest by a lot. That gives us a net profit growth of 40%, which is still historically high, but I don't know what else I can do here. So yeah, so earnings per share, that gives us $2.17, which is close to double what I mean, we're talking about historical high numbers here. You tell me, what else can I do here? Unless the revenue is going to fall because of the outsized sales, let's do that. Let's bring down the revenue. Let's make it flat. Let's say they don't grow revenue at all. All right. That still gives us a historically high earnings per share. All right, so let's assume that for the first time in ever, this company actually loses revenue year over year. If we do that, then that gives us right around $1.55 in earnings per share, which puts us in line with, I'd say, still, you know, well, let's look at this. Wait a minute. So they've grown earnings per share consistently year over year. So we have to give them that. But that $2 is a decent jump. Let's see what the difference is. So I didn't look at this before. Never really needed to. I know this video is going like super long. 31%. 25. So yeah, that's about right. Okay. So I'm fine with that. So yeah, so earnings per share, 217, historic high, but that's common for this company. All right, that gives us a PE of 1771, which is roughly 12% of the stock price, which is historically high. So it's really hard for me to give us that, because that gives us the price is currently lower than the COVID low in 2020. In 2020, it was 11% of the stock price, and now we're saying it's 12%. So that's hard to say. And then PE of 1190 on the low end. So that gives us a stock price of 25.83 on the low end and 38.43 on the high end. Again, I can't, there's no way. Now, with all this being said, we know that the stock price does move primarily on the balance sheet and not on the profit loss, okay? And so that means that we can sort of take with a grain of salt this valuation that we're getting with the profit loss statement, because we know that the majority of the stock price is going to move based on the balance sheet. And based on the balance sheet, we know that the stock price is, we'll say, fairly valued, right? Currently it's at 18. We know that the high is somewhere around the $25 range. It has been $24, even though we know that $24 is really coming off of the back of 2021. Still though, the math says that in year 2022, the stock price has been $24. Can it get back there? Yes, it can get back there. But again, in order for it to get back there, we really have to see something turn around in the real estate sector for that to happen. Can that happen? Yes, it can. Can the real estate sector continue to be a laggard? Can it continue to be one of the worst performing sectors in the economy? I don't think so. I don't think so. At some point, there will be a story, right, that says that rates are going higher, therefore rents are higher. You know, unless we start to see a real recession, then I don't think we get lower than that 16. The other thing is that as far as we can tell, the stock price is currently at the bottom end of its range. And so if we were to pick up this stock at roughly $17, I think we'll be getting a decent deal for it. again, as much as I want to figure out this valuation on the P&L, I don't think it's going to happen, because in order for us to get some semblance of um, reality on this stock valuation, the earnings per share has to come way down. Matter of fact, let's see if I can get it. So we bring it to 1.65, where it was last year. So that still gives us, 1964 and 29. Can it get there? Yeah. Does it get there today? Maybe. I mean, it can definitely get back to 19. No questions asked. Does it get to 29 though? Is the question. And in order for us to use this valuation, we have to assume that it can get to 29. But what gets it there is this thing. So anyway, I think that's it. Again, I'm calling Medical's Properties Trust fairly valued at the current time. I don't see it as undervalued, don't see it as overvalued. Again, I do see a stock price ranging anywhere from $16 to roughly $25.